I'm Guillermo Narvaez, Technical Tax Director of the Global Tax Group of Kreston Global, and this is the 2022 January edition of the InTax News. In this edition, we have news concerning international tax matters, like the new rules proposed by the Netherlands concerning controlled foreign companies, things to have in mind about virtual currencies, the new version of the Transfer Pricing Guidelines 2022, and the new income tax regime in the United Arab Emirates. Welcome to the program. The news to discuss in this edition is divided into two videos. In the first one, cryptocurrencies. Is the global legal tax framework prepared to govern operations with virtual money? The new transfer pricing guidelines. The new version of 2022 includes changes set out in BEPS and guidance on financial transactions and the transactional profit split method. And in the second video, the news is Netherlands. Amendments proposed to update the rules to determine when a controlled foreign company or CFC should be reported in the Netherlands according to the new legal framework. United Arab Emirates. The UAE has decided to levy corporate income tax, but the new rules to be applied from 2023 are still comfortable to attract new investments. Welcome to the 2022 January edition of the InTax News program. I trust you enjoy it. Sometimes it's not easy to understand how a phenomenon like crypto assets has been grown during the last 10 years. Probably the best example of that is Bitcoin. One of the most important features of Bitcoin is the lack of identification of the parties in the operations when crypto money is disposed of. Bitcoin can be used as an investment instrument, but also as a means of payment, although it doesn't have an intrinsic value and is not an underlying commodity or a sovereign currency. Cryptos are known as virtual currency. However, they are not supported by a public authority nor regulated by third parties. It's debatable that Bitcoin could be regarded as a virtual currency and further as a legal tender, but facts demonstrate a different context. More and more Bitcoin and other crypto monies are part of thousands of transactions every day with certain benefits over traditional deals with fiat currencies, like lower costs of administration. Taxes get into action when a Bitcoin is whether created or transferred from one person to another. It's common practice to consider the disposal of cryptos as a taxable event. There are three groups of transactions to be considered from a tax perspective. Exchange of cryptos for fiat currency, means Bitcoin for euros or dollars, or for another crypto, Bitcoin for Ethereum, or for products or services as a means of payment. But things get complicated when those involved in a transaction, private players and authorities, don't find a proper legal framework to apply to operations with cryptos. The consequence is to apply the general rules for currencies or transfer of assets. In most cases, the general rules can be applied if cryptos are deemed assets, but due to the lack of legal provisions created for the new context of virtual assets, that could create undesirable results. The context turns more complicated when jurisdictions give different meanings to crypto assets, moving from intangible assets to financial instruments, commodities, means of payment, or even currency. Moreover, El Salvador in Central America has accepted Bitcoin as legal tender. All this background generates a more complicated context from an international tax perspective, where double tax agreements must be applied when operations with cryptos are carried out by residents of two or more states. Most countries consider the exchange of virtual currency and its tax consequence as capital gains, and this could lead to events to be taxed only in the resident state and not in the other state or source jurisdiction if the corresponding DTA has included a paragraph similar to paragraph 5 of Article 13 of the OECD model. All these facts and circumstances will most likely produce a diversity of case law and different criteria by the judiciary with regard to applying the old and traditional rules on income, property, transfer of assets, foreign currency, and the like, and generating light on this matter in countries that do not follow a code law system like the UK or the US. For instance, there is one still ongoing litigation procedure in Germany, a code law system country, where everything to be taxed should be clearly stated in a legal statute, at least when a natural person is involved in a taxable event. In Germany, there are several chapters to classify income in the tax law, including a general chapter of other income. However, a taxpayer questioned the foundations of taxing a disposition of virtual currency from a constitutional perspective. What this taxpayer did was to confront the basic principles of the German tax system, trying to demonstrate a lack of grounds due to inequality on the provisions concerning other income. Theoretically, all persons are equal before the law, and this principle is one of the keystones in the German legal structure. This matter is still in process, therefore is not the end of the story. On the contrary, we look forward to reviewing the outcome of this case in Germany, and certainly many others to come in the near future. What we can assure is that crypto assets and transactions related to them must be taken as part of our normal way of doing business. The OECD has presented a new version of transfer pricing guidelines, updating the last one of 2017, incorporating the main takeaways of the BEPS project that were not included in the guidelines yet. The main changes of the new version focus on financial transactions, hard-to-value intangibles, and the transactional profit split method. These changes have a solid background. BEPS dedicated Action 8 to the analysis of hard-to-value intangibles, and 2 years ago, the OECD released its guidelines on financial transactions and the guidance on the application of the transactional profit split method based on Action 10 of BEPS. The guidance on the profit split method was issued in 2018. The novelty is that such changes structured years ago have been incorporated into the guidelines conforming the new version in 2022. All these new measures were accepted as new standards by the Inclusive Framework since 2015, as part of the plan agreed by the G20 in that year. Recall that the Inclusive Framework is the joint effort of 141 countries and jurisdictions around the world to update the international taxation framework. In the case of the profit split method, the OECD determined that this method should be applied where it's found to be the most appropriate method to the case at hand. But it significantly expands the guidance available to help determine when that may be the case. The profit split method was included in the guidelines in the version of 1995, but it's until 2010 that the guidelines start pointing out the importance of the PCM. Discussions around the method were held in 2014, 2016, and 2017, and that was the reason to update the guidelines until this current version of 2022. In a nutshell, the main strength of the profit split method is to offer a solution when the participants in the transaction make unique and valuable contributions, as well as in cases of highly integrated activities. What is important to have in mind is that the profit split method should not apply to operations with simple functions, low risks, and lack of unique and valuable contribution. Last, but certainly not least, it's not advisable to use this method when intangibles are not involved in the operation.